Welcome everyone to another episode of Mere Finance. We're going to talk about inflation. How can a investor protect or hedge against inflation? So, the most common ways are TIPS, Treasury inflation protected securities, or inflation swaps. What is an inflation swap? An inflation swap is basically an interest rate swap. A swap is a derivative when you exchange one risk for the other. So it's a transaction where one party transfers inflation risk to a counterparty in exchange for a fixed payment. So when an investor buys, let's say, commercial paper that yields 2%, they expect after the commercial paper matures, the payment of 2%. But what happens if inflation is higher than that 2%? Then the real returns will be negative. So these investors wants to avoid that. So the investor then enters into an inflation swap contract, receiving a fixed rate and paying a floating rate linked to inflation. This could be certain benchmark plus 30 bips or plus, 1 month LIBOR and so forth. So the goal is to turn the inflation component into fixed. Basically, it's to be able to know that, all right, doesn't matter how high inflation goes, I know I'm just going to pay a fixed rate because in return, I'll getting a benchmark plus inflation. Now, how is this different to Treasury's inflation protected securities? Treasury securities that are protected from inflation are basically paying you the notional amount plus inflation. So let's think about it. There is a bond that is trading at 100 at par. Then inflation is 4%, so you will get your yield plus that percentage of inflation. So you will get, say it's 4%, you will get 104 for your principal because it's inflation protected, but the yield will be lower. So if we see here, for example, a real yield in a 5-year, as of 3/3/2023, would be 1.55. Basically means if inflation is, again, 4%, so you get 104 back from your principal plus a yield of 1.55. However, your nominal yield is around, well, if you sum here 1.55 plus the break-even rate, which will be 2.71. We're talking about a 4.26. So, and your nominal will be 4.26. So, basically, if inflation is higher than 2.71, then you would rather go into the real yield. But the thing is, with this kind of securities, you are basically gambling, and you also don't know if the real yields and nominal yields are actually correlated to inflation. What if the market is mispricing inflation and then you're getting a yield that is actually not reflecting that? So then inflation swaps have a different way of assessing inflation because they have had a negative correlation with US Treasury. So most TIPS strategies, like the one we talk, have real interest rate duration of approximately to 5 to 8%. We saw that in the previous graph. The real yields start at 5% and 5 years, and they go all the way to 30 years. So while CPI swaps offer a pure inflation exposure, you can see here the 5-year CPI swaps negatively correlated to US Treasuries, while TIPS all the way in the left, 0.56 correlation with US Treasuries. So not much diversification there. And also for the second one, CPI swaps have had a positive correlation with inflation. And this is where we want to be. We want a security that is closely correlated to inflation so it can protect us when we get exposed to it in a swap, right? Because due to the direct exposure to CPI inflation, CPI swaps can effectively capture the difference between expected inflation and actual inflation. This is what we were talking about before. The difference between expected inflation and actual inflation can be costly to an investor if the market is not pricing the actual difference, because as expected inflation goes up, it tends that actual inflation also goes up. up. But there could be also a mismatch there, and that could be severely costly for investors. So we believe that inflation swaps, yes, they are more expensive. Yes, they carry counterparty risk. But if you are in an institutional space, even in a retail space with good knowledge of inflation, I think it's good to have inflation swaps just to hedge your inflation, especially in these times where inflation has come up and the Fed is not controlling it. So I think inflation swaps are a good option. They capture pure inflation risk, and you don't have to gamble with real rates or break-even rates. So let us know what you think about it. If you like this approach, or if you prefer the tips approach, or if you just prefer to go with gold as another way to protect from inflation. So thank you for watching. Stay tuned for more episodes of Mere Finance.